Hello everyone, welcome to Accounting 1, Semester 2, Week 13, video lecture number 9. And the topic is combined nominal ledger and final accounts for a limited company, and this is a revision lecture. Okay, we're going to cover this subject using a typical exam type question. And the company we're looking at is Computel Limited. So let's look at the question first and then see how we might approach such a question. So we're going to do the nominal ledger, and the final accounts, and at least part of the nominal ledger. We may not be asked to do the full nominal ledger, but the relevant parts of the nominal ledger that are required. Okay, Computel Limited. So let's read the question, and as we'll see, we're going to be presented usually with two pieces of information, and that would be the opening balances of the year we're going to do. Okay, the opening balances, and then the transactions, so a list of transactions. Now, in this case, we're in luck because it's just a new business, so it's a business. Computel commenced on the 1st of February 2019. So for that reason, there'll be no opening balances in this question. So all we're going to deal with then are the actual transactions. So if it was an existing business, we'd also have the opening balances to contend with. So, okay, let's see what the transactions are then. So there's a number of transactions. So it says on that date, in other words, on the 1st of February, the first day of the business, 50,000 ordinary shares with a face or a par value of €1 each were issued at par. So the company issued these shares, sold these shares to shareholders, and the proceeds of this share issue was lodged to the business bank account. And this is what you'd expect. So the company will have opened a bank account, and any money it received from the shareholders would be lodged into that bank account. So that's our first transaction, a very typical transaction between the business and the owners of the business, the shareholders. So during the year ended 31st of January 2020, the following additional transactions occurred. So we have a list of them, and these are very typical transactions that any business would enter into, any company would enter into. So let's just go down through them and see what we can say about them. The first one is the purchase of equipment for 180,000. So we probably purchased this equipment at the beginning of the year, and I think we'll assume that equipment was paid for. Okay. Then we've got the purchase of stock on credit, 160,000. Now this obviously is what was purchased. The company would have received invoices from its suppliers in respect of this stock, but of course it probably wasn't all paid because it's on credit. A good amount of it would be probably, and we'll see how much has actually been paid for these purchases of stock. So remember, when we see the word purchases, this purchase of stock is what we refer to as purchases in accounting, whereas the purchase of equipment is not regarded as what we call the term purchases. Okay. The next one is a term loan. So money was borrowed by the company, 150,000 at some time. So we'll probably see some other transactions in relation to this loan, like how much interest was charged by the lender, and how much repayments were made during the year. So we'll have a look at that loan. Next thing that happened was there was purchase of a motor vehicle for 30,000, and again we'll assume that was paid for. Credit sales during the year, again these are invoice sales. We would have sent out invoices to our customers, 580,000 euros worth. Now all of that won't have been paid, so we'll have to we'll get information about how much of that was paid. Rent and rates paid, 60,000. These are expenses of the business, of course, wages, another expense, 180. Cash received from debtors. So here we have, this is what we were looking for, the cash received from our customers or our debtors, 420,000. And the sales were 580. So if we sell 580,000 euros worth of goods to customers and they pay us 420, it's easy to work out how much is owed at the end of the year. But of course, these calculations are normally done, as we know, in the nominal ledger. Okay, but it's not a difficult it's not a difficult calculation. The next transaction is payments to creditors for the stock. Remember, up above we purchased stock for 160,000, and now we're going to make payments during the year were made by our company to our suppliers of 110,000. So it's easy again to work out how much is owed, how much do we owe our suppliers in respect of this stock. Dividends paid, so we're in the first year, unusual enough I suppose, but dividends have been paid by the company to the shareholders. Okay, so we received some money, the company received money from the shareholders as an investment, and pretty soon in the first year dividends were paid. Perhaps a bit unrealistic, but that's what's happened. Okay, so dividends have been paid. Term loan interest charged. So this is the interest that the lender has charged on the loan, and we know what happens with this 12,000. The bank or the lender will just add that 12,000 onto the loan amount of 150,000, and will mean that the total amount owing then at that point would be 162,000. Okay, next transaction is motor expenses paid, just another expense. Directors' remuneration paid. So every company, as you know, has directors, and they have to be paid for their work, I suppose, and that's what they've been paid. So it's an expense of running the business. Okay, 25,000. And the last transaction, I suppose, is what did we pay off the loan? And it says here that the loan repayments, the term loan repayments, were 30,000. So that will reduce the loan balance. So the interest that was charged will increase the loan balance, and the loan repayments will reduce the loan balance. So many of these transactions, of course, will be worked out, or the figures for the final accounts will be worked out in the nominal ledger. Okay, so but however we're given some additional information. Okay, and some additional information, and this is very typical again. Information that you would be given about the company. So the first is that the stock, the closing stock at the end of the year, 31st of January 2020 is the year end, and this, the closing stock, the unsold goods, the unsold stock that we haven't managed to sell, that the original cost of this, or the value of it, was 50,000. So we've got to make an accounting adjustment, as you know. Okay, so this accounting adjustment will adjust two figures. So we're going to have this closing stock in twice in the accounts. Another piece of information is that all money received by the business is lodged to the business bank account. Well, that's good business practice, I suppose. And so we know that all monies we received, whoever we received the money from, okay, that money will be lodged into the business bank account. So who do we receive the money from? Well, we receive money from our customers, of course. The company received money from the customers for the sales. The company has received money from the shareholders, share capital, and the company has received money from the lender. Okay, so all of that has gone in to the business bank account. So these would be the lodgements to the business bank account. Number 3, all payments are made by bank transfer. Okay, so any payments that are made to whoever, to the creditors, or to in respect of expenses, or whatever the amounts were paid, came out of the bank. So we have kind of an automatic record then. This bank account will give us an automatic record of all the monies coming into the business, into the company, and all the payments being made out. Okay. Another adjustment we're going to have to make is number 4, assume depreciation at a rate of 20% per annum on cost. Now you're familiar with this method of depreciation, percentage of the cost. It's called a straight line method of depreciation. And in the first year it's very easy. Or in any year really, it's just 20% of the cost, and so that's easy to calculate. So we make an adjustment again. It'll affect two figures in the accounts when we're doing it. The last bit of information is that because it's a company, companies pay corporation tax on their profits, and we've worked out, or someone has worked out, an estimate of what the corporation tax is going to be, and we don't have to worry about how that was done. That information will just be given to you in an exam situation. So we reckon that 15,000 is payable. So normally when companies are paying corporation tax, they actually pay the bulk of it in the year of account that we're talking about. But for some reason this company hasn't paid any corporation tax. I suppose it's the first year or whatever, and so that's going to be owing. That corporation tax is going to be owing at the end of the year. So what have we got to do? Okay, in the exam question, what will you be asked to do? So you're given those transactions. Now, sometimes you will also be given some opening balances, but in this case, we're just given the transactions that have occurred during the year and some adjustments then that have accounting adjustments that have to be made. So what are we going to do? Well, normally, of course, what we would do first is the nominal ledger. We would calculate or prepare the nominal ledger using all those transactions, and we'll debit one account and credit another account and so on. And we're familiar with that. We've done that in our lectures on the nominal ledger. So, but in this case, we're not going to. We're asked. I think we'll do the question in the order that it's given here. So any work on the nominal ledger we leave until we're asked for it. So the first thing we're asked for is to calculate the profit for the year. Okay. Now, normally, of course, as I said, we would do the nominal ledger first, but there's no real need. I think we'll be able to do the profit calculation, and we do that in what's called a profit and loss account, or a trading profit and loss account. It's sometimes called an income statement. So we'll do that document and we'll calculate the profit for the year. I think we'll be able to do that without going to the nominal ledger. The next thing we've got to do, I suppose, will be the balance sheet. Okay, now to do the balance sheet is the other part of the final accounts. Now we will need to do some calculations. So that's why we're asked here in B, prepare ledger accounts. And remember, the ledger accounts are in this nominal ledger. So we've got to do not the whole nominal ledger, but just some of the accounts in the nominal ledger we're asked for. Now remember what the nominal ledger is. It's a collection of ledger accounts, or T accounts. And we're not asked to do them all in this example. We're just asked to do some of them that we really need to do the calculations for in order to do the balance sheet. So what we're going to do is we're going to do a T account for the bank, a ledger account for the bank, which will have a debit and a credit side, and cash in on the debit side and cash out on the credit side, and we'll calculate a balance that's to go into our balance sheet. And the same thing with the debtors. Now again, we said that wasn't a difficult calculation, but we'll have to do it in the form of a T account. So on one side, on the debit side, we'll put the sales, and on the credit side, the cash received from debtors, and we get a balance, and that balance goes into the balance sheet. Same thing with the creditors. We're going to put the purchases of the stock into our creditors T account, and how much did we pay our creditors for the stock, and how much do we still owe them. That would be the balance, and the balance goes into the balance sheet. And also then we're going to have to do a T account, or a ledger account, for the loan. And on one side we're going to put the money borrowed, and on that side we'll add on so this will be on the credit side, we'll add on the interest, and on the debit side we'll put the loan repayments in, and we get a balance, and that balance goes into the balance sheet. Okay, so we need to calculate those figures in order to prepare the balance sheet. So we're going to part of the nominal ledger, if you like. The next C we're going to have to do is the balance sheet itself, which is a list of balances, of assets and liabilities at the end date, the accounting date, 31st of January 2020. And the last piece of information we're going to be asked to do is to advise the company on a number of kind of important measurements, or issues, I suppose, affecting the financial affairs of a company. And we're going to advise the company on the profitability. So we'll be talking about what do we mean by profitability, liquidity, and solvency. Okay, so I think maybe we might just explain those issues again. We've done it in the past, I know, but when we're talking about the profitability, of course, we're talking about the profit calculation and the profit and loss account, and you know how it's calculated. The profit, how it's calculated is, I'll just get the okay, so the profit of a business is, we can express it as an equation. So P for profit equals the revenues of the business minus the expenses. and we're going to do that. And in the accounts of a limited company, we'll do that. We'll subtract gradually the expenses from the revenues. But in the accounts of a limited company, we also say, well, that profit, where did that profit go? Who took the profit? So we'll be doing an appropriations account as well. So we'll see how that works out. We're going to advise the company. Well, okay, we're advising the company on profitability. Okay, I suppose we'd be advising them on, in order to increase the profits, I suppose we might be saying, okay, we're going to have to either increase the revenues or reduce the expenses, and that will improve the profitability of the business. So we'll see what it looks like when we do that calculation. Liquidity then is another issue, and here again we can express it as an equation. And I suppose when we're talking about liquidity, we're talking about cash flow. And cash, as you know, can flow in two directions. It can flow into our business, okay, and it can flow out of the business, okay. So cash in minus cash out, okay. So when we're talking about if a business has a liquidity problem, it means that the cash out is greater than the cash in, and that would give us either a surplus, okay, surplus if we're in luck and if there's more cash coming in, or if it's the other way around, it'll be a deficit if there's more cash going out, as you know. So this is a very simple kind of concept. Everyone understands a cash flow. We all have to deal with it one way or another. And in this example, where we're going to show the liquidity situation, I suppose it won't be in the final accounts, I suppose, although there will be a bank balance or a surplus or deficit in the balance sheet. But where we're going to show, if you like, in the exam question at least, is the cash in and the cash out will be in this bank account up here, okay, in the bank account. So that's where we're going to show it. Okay, the solvency then is another major issue affecting companies, all businesses, I suppose, and it can be expressed as an equation as well. And what we have here is we're going to look at the assets of the business. I'll just say A for assets. And we're going to subtract the liabilities at any point in time, but we'll be talking about the 31st of January. And a business is solvent, I suppose, if the assets are greater than the liabilities. So we know that this balance sheet expresses this. We talk about the assets and liabilities in the balance sheet. So the equation is assets minus liabilities equals capital. So a business, I suppose, will be regarded as solvent if the assets are greater than the liabilities. So the left-hand side of the equation here would be positive, and so would the capital, or equity sometimes we call it, would also be positive. And a company would have a solvency problem, or would be insolvent, if the liabilities were greater than the assets. So the left hand side of the equation would be minus, and also if the left hand side is minus, the right hand side is minus. So the capital or equity would be negative. So we'd have negative capital, negative equity. Okay, so that's what we're about here. Okay, that's what we've got to do. So let's go up and see what we can, what kind of, how we can get our thoughts around this and how to actually do it. Okay, so I think the first thing that is important to get to be clear on is the year that we're doing. Okay, the actual accounting period, to make sure we know what it is for sure. Okay, and let's just draw a line maybe to describe that year that we're doing, that accounting year we're doing. So it has a start and it has an end. Now I think we know what the end date of the accounting year is. So this is time, or this is the account. I just put it in here, accounting year. Okay, so here's our accounting year, and we know the date that it ends. This is on the 31st of January 2020. So that's our end date, if you like, our balance sheet date. Okay, and this is where we have what we call the closing balances. Okay, on that date we'll have closing balances. And these are the closing balances that go into the balance sheet. And the first day of the year is exactly a year prior to that, so we know what date that was. I think we're given that date as well, the 1st of the 2nd, 2019. So there's our accounting year. And very often we would have opening balances there, but as I said, because this is a new business, we don't have any opening balances, which makes it a bit easier for us, I suppose. Okay, and what we're given then, if we're given the opening balances, or in this case not, what we're also given, I suppose, is the transactions in this particular example. What occurred? Okay, what occurred during this year? And based on those transactions, we're going to try and do our final accounts. Okay, we're going to do our final accounts. And which should show us what we're interested in, the profitability, liquidity, solvency, and so on. And in addition to the transaction, of course, we have these extra bits of information that we're told about depreciation and closing stock, and what the corporation tax will be, and so on. Okay, so we'll have to adjust for that, make those accounting adjustments. Okay, so what we might need to do, okay, if we're going to be doing these accounts or doing adjustments particularly, I think we all should also have in mind this rule. I'll just write it in again, okay, this rule of double entry accounting, because I think it's important. So let's see what that is. Okay, so I just call this the rule of double entry accounting. And all it says is that there's 4 types of figures in accounting, as you know. 4 types of figures in accounting, and maybe we'll just change the color a little bit. Okay, and these are assets, liabilities, expenses, and revenues. And when we have these transactions, or we're trying to record these transactions, which we will, in the nominal ledger, the various ledger accounts that we need. So these when we have transactions, they will either increase or decrease these figures, whatever they are. And the rule in accounting, as you know, is that when we increase an asset, I think I'll just put in, maybe make that in red of some description. Okay, so we'll leave it in red. So when we increase an asset, we debit. When we increase an expense, we debit. Okay, when we reduce an asset, we debit. Okay, and when we, no, that's not right. Sorry, when we reduce an asset, we credit. I just have to, okay, so I'll just get rid of that. Okay, so when we reduce a liability, we debit. So it's easy to get this mixed up, even. Okay, and when we reduce a revenue, we debit. Now I'm putting it in red because this idea in navigation that anything on the left is always in red, the port side. And just going to do that, make it a little bit consistent, I suppose. So left is usually expressed as red, okay, and on the right then we usually express it on the starboard side, I suppose. We always express it as green, okay. So if we're increasing a liability, we credit. Credit just means right hand side. Credit, and credit. So there's our rule. So we'll be following that rule when we're doing our T account. So it's important that you don't forget that or mix them up like I just did. So that's that. Okay, so let's go, and I think the first thing we'll do is we'll do our profit and loss account. Okay, we'll do what we're asked for first. So we go down here and do that. Okay. Right. Okay, so let's do a profit and loss account. Maybe I'll do it in, should we do it in blue? Okay, so the first thing you put in is the name of the business, okay? And the name of the company, of course, is Computel Limited. So let's put that in. So it's a private limited company. Okay, so if it was a public limited company, of course, we'd have the PLC or something like that. Okay, so the name of the document then, as I said, there's a number of different names. Well, I think we'll just call it the profit and loss account. Sometimes it's called the trading profit and loss account. And we do it for a period of time, and the period is the year ending 31st of January It's not the calendar year, it doesn't have to be the calendar year, although very often it is. 31st of January 2020. So that's our heading, I suppose. So it's important to know what we're actually dealing with. Okay, so we're going to put everything in. Then we're going to need a currency symbol. Okay, so I just do the currency symbol here, and the first figure, of course, is the sales figure. Okay, so what were the sales? So there's two possible figures we might put in here for the sales. Is what did we invoice our customers? That's one figure, and what did they pay us? That's the other figure. So which do we put in? Well, as you know, we put in what we invoice, what we actually sell, regardless of whether this was paid for. Okay, so the full amount of our sales, and then the cost of those sales, those goods that were sold. How do we do that? And we know that there's this formula, and I think we explained this in a previous lecture. We obviously did explain it. How to calculate this cost of sales figure. So this is not new. So we've got the opening stock, the cost of the opening stock that we had at the beginning, and of course, because it's a brand new business, the opening stock was 0, and there was some purchases during the year, purchases of stock. And again, is the purchases figure what we bought, what we received invoices for, and what we actually bought on credit, or is it what we paid for these purchases? And the answer, of course, is it's what we bought, regardless of whether we actually paid for these purchases or not. Okay, so we add the cost of the opening stock to the cost of the purchases. Not a difficult calculation. Okay, but we take away, we don't include the cost of any stock that we didn't sell. So we're going to take away the cost of the closing stock. And we won't include that this year. We won't say that's an expense this year. That was 50,000 we were told. So 50,000 of the 160 stock purchased has not been sold. So we don't include that as an expense of this year. So what we want to do is compare like with like. So we want to compare the revenue from the stock sold with the cost of that stock that was sold. So it's we refer to it as cost of sales or cost of goods sold. So that's the figure we're after. And when you subtract the 50,000, of course, the cost of goods sold or sales is 110,000. So that's that. So they're the two figures we're going to subtract from each other. So when we subtract the cost of sales from the sales, we get what we call the gross profit of the business. Okay, and the gross profit is 470,000. 470,000. Okay, so what we refer to there, sometimes we refer to that part of this profit and loss account, we refer to it as the trading account. Sometimes that's what we refer that to. Okay, so sometimes the whole thing is called trading profit and loss account. Okay, the next thing we do is the next part of this document. I think it might change color maybe. Let's do it in red. Okay, the next thing is what's sometimes referred to as the profit and loss account part, or of the profit and loss account, if you like. And what this very often comprises of two sections. One is if there's any other income coming into the company, some subsidiary income, like maybe rental income or deposit interest or discounts received, things like that. We would put that in and we refer to it as other income, and we'd add it on to the gross profit. But in this case, there's no other income, so we're just going to go straight on to the expenses. So we see what are the expenses of this business in this year. Now, it doesn't really matter what order you put them in. Very often we do what companies like to disclose are positive things in the beginning, and sometimes they have to disclose things like directors' remuneration. So very often they're the first things we put in. So let's put in the director's remuneration first. Okay, remuneration, which is just director's pay, and it could be different kinds of pay, salary it might be, or fees or bonuses or something like that, and it's 25,000 we're told. The next one are wages paid. These are expenses. and the wages were 180,000. Okay, so the wages would be gross wages, including employers' PRSI, but there's no mention of any of the payroll taxes. So the only figure we have is 180,000, so that's all we put in. It is rent and rates. Okay, rent and rates. So rent paid to a landlord, and very often the rates are paid to the landlord, but they eventually go to the local council or whatever for services provided. And the rent and rates in this example are 60,000. Motor expenses next. These are repairs to motor vehicles, motor expenses, or maybe fuel or insurance and tax and things like that. Anything to do with the running of motor vehicles. So that's 180,000. No, that's 18,000. The next expense we have is to do with the loan. The cost of borrowing money is an expense. So it's only the loan interest here, okay, not the loan repayments. So it's the only what the bank have charged us for the privilege of lending us borrowing money from them, and that is 12,000. So that's it. So there's 5 expenses there. Sometimes this list can be quite a long list, but in this case it's not too bad. Okay, and the last expense that we have is this adjustment for depreciation. So let's put in the depreciation. This wear and tear. It's a provision, as you know. We've done lectures on this provision for depreciation, so I think we're clear on it. So it's a reduction in the value of assets because of the passage of time or wear and tear or whatever. So we've 2 types of fixed assets that we're going to depreciate. So let's do the calculation for equipment, and it's easy enough to do it here. I think it's 180,000 is the cost, and we're told that the annual rate of depreciation is 20%. So we just put it in like that, and we calculated 36,000. And we do the same for the motor vehicles. Okay, and the motor vehicles, the cost, again 30,000, and the same method of depreciation, same rate. So it's just 20% of the cost, and that's 6,000. Okay, so I think that's all our expenses. Okay, so we'll draw a line underneath it, and we will add them up. Okay, so we're going to add them up, and the total will come to, just put it over here, maybe just bring it down a little bit, 337. So I'll just go up and see what we're going to subtract that from. So the 337 are our expenses. And remember, we said when we were talking about how to calculate the profit, we subtract expenses gradually from the revenue up above. So we're continually subtracting these expenses. So the gross profit was 470,000, and we're going to subtract from that the 337, and we'll get this net profit, or in the case of a company, what we refer to as profit before tax. Before tax. Okay, PBT, and the profit before tax is 133,000. So that's the real profit of the business, the bottom line. Sometimes it's referred to as, at least in America. So okay, so that's the profit before tax. So it looks like the business is profitable. Okay, so we were asked to provide advice to the company. So I suppose if we're going to advise the company on profitability, we'd be saying, okay, these expenses need to be controlled a little more. If you want to increase your profits, don't pay your directors as much or whatever. So try and reduce the rent or something like that. So we try and control, cost control is what we're about, or else we would try to increase our sales. And we know when we're talking about an increase in sales, just put it in here, I'll leave it red. It's price by quantity usually we're talking about here when we talk about our sales. The quantity sold multiplied by the price of each unit. So if you want to increase your sales, you try to increase your price maybe, once it didn't have a negative effect on the quantity, or sell more. We sell more goods, the revenue, the sales go up. So remember that the sales here is our revenue figure. Okay, and we're gradually subtracting our expenses to get our profit figure. Okay, so there's our expenses. And we end up then, I suppose, with the profit. Okay, so that's the profit. Okay, the profit. Now, in a company, if this was a sole trader, we'd finish it here. Okay, we wouldn't proceed any further. That's the last thing we would do. However, with a limited company, we go on to a final stage in this profit and loss account, and we refer to this final stage as the appropriations account. And really, appropriations are things, what do we do with this profit? Who gets the profit? Who takes this profit? And the first group of people who take this profit, maybe I'll do it in a different colour to divide it up. So we have the profit before tax, and we'll start with our appropriation. So the first one is tax. Okay, now we don't have to actually say what kind of tax it is. It is the corporation tax, of course, but it's kind of obvious the only tax that this could be is the tax on the profits. We call that corporation tax, so there's no real need to say to use the full term corporation tax. It couldn't be VAT or PAYE or anything like that. So it's a corporation tax, and we're told that we believe that the tax on this is 15,000. So we're going to subtract that, and we're going to get a figure called profit after tax. So if we take the 15,000, so of the 133, 15,000 is going to the government. So what's left? 118,000. So that's our profit after tax. Now what else? Who else is going to take some money from us? Well, I suppose the shareholders. Okay, the directors must have recommended at an AGM or something that the shareholders get some dividends. So we put in the dividends. Now, I forgot to say about the tax, whether this tax has been paid or unpaid. In this case, it hasn't been paid. So whether it's paid or unpaid, we still put the tax in if it relates to this year. And it's the same for the dividends. If these dividends have been paid, in this case they have all been paid, but sometimes we might have dividends that have not yet been paid. They've merely been proposed or approved at the AGM. And at that stage they become owing, I suppose, to the shareholders. And in that case, even though they haven't been paid, we put them in here as well. So all dividends, paid or unpaid, once they relate to the profits of this year, the year we're doing. So the dividends are 60,000. Okay, these have been paid. So what's left then? Well, what's left is 58,000. So 58,000. So what do we call that 58,000? So that's that's the amount of the profits that have been kept within the business for maybe future years. Maybe it might go to the shareholders as dividends next year or whatever. But at the moment it's been kept or retained. So we call that the retained profit of the year. So the retained profits. Retained profit. Okay, so what do we do with that retained profit? Well, what we normally do is we would add that retained profit to any retained profit from previous years. Now in this case there's no previous year, so there's nothing to add it to, but I think I'll just put it in anyway, because in other examples it might not be the first year. So what we'll put in here is the retained, well, what we'll call it instead is, we'll call it, nope, we're going to call it revenue reserves. Revenue reserves, and this is just a term meaning retained profits, and we give the date of retained profits on the 1st of February 2019. Remember the first day, and of course they're 0, but in other examples if it wasn't the first year it wouldn't be 0, so we're just going to put it in just for completeness, and then that will give us our revenue reserves at the end of the year. So we're going to add these two figures together. So the revenue reserves then at the balance sheet date, I suppose, which of course is the 31st of the 1st 2020, and that will be just the retained profits of the current year, and that's 58,000. So I suppose that money there, that profit, that retained profit, is money that's technically at least owed to the shareholders at the balance sheet date. So what it becomes is really part of capital, although we always keep it separate. In the case of a company, we keep the share capital and these revenue reserves or retained profits separate from each other, but they're both at least technically owed to the shareholders. So they're going to go in the balance sheet as an amount owing to the shareholders. So that's our profit and loss account. So our profit and loss account then is in kind of three parts. Okay, the first part we said was the trading account, and this section here, I'll just let me see if I change the color. This section here, from gross profit to net profit or profit before tax, normally is just referred to as the profit and loss account part of the profit and loss account. Strange, but and then the last section, then the last part of the profit and loss account is this one. I'll just put it in green again, and this section here, and this section is I suppose our appropriations account. It's what we do. What do we do with the profit when we make it? Who do we give it to? Who takes it? So that's our first document. Okay, so the next thing we're going to do is we're going to go on to section B. So that was section A. So we do section B up here. Whoops. Okay, so the next thing we've got to do, I suppose, the next part of the final accounts, of course, is this balance sheet. Okay. Now, before we do the balance sheet and before we do the nominal ledger, let's just talk briefly about the balance sheet. So let's do that. So our balance sheet, okay. So we're going to be talking about our balance sheet at the end of the year. Okay. And the balance sheet is just a list of balances, okay. And they're balances of assets and liabilities, essentially, right? So we're going to do the balance sheet at the 31st of January 2020. Now, this is not the balance sheet we're going to do, but I'm just going to say what are the figures that are going to end up in the balance sheet. Well, what we said was that the balance sheet is a list of assets. Okay, so let's see what assets there could be at this balance sheet date, and also there'll be liabilities. And of course there'll be capital. You know, this is an equation. The balance is an equation. So very often it's called the accounting equation. So we've assets, liabilities, and that they should be equal to the capital. So at the balance sheet date, what will the assets, liabilities, and capital be? Well, okay, the first type of asset, let's talk about the fixed assets first. So we're going to have equipment. Okay. So how do we calculate the equipment? Well, the equipment, the original cost of the equipment, maybe I'll just put it in little brackets here. So the original cost was 180,000, and we said that we're going to reduce its value with this provision for depreciation. We said that it was 120 or 20% has been taken from the value of these assets over the year, and which we said was 36,000. So the value of the assets then, of the equipment, the first asset I suppose is 144,000 when we subtract that. So that's easy to do. We can do it in our head. As I said, normally though we'll do this in T accounts, but we're not going to bother. We're only going to do a certain number of T accounts, but it's easy. That figure is easy to calculate. The next one then is the motor vehicles. It's our next asset. Okay. So how are we going to calculate that? Well, the original cost was 30,000, and again we got 20% of that as the depreciation, and which was 6,000. So we can see that the book value, the value of the motor vehicles in the books of the business is 24,000. So there's our two fixed assets. Okay, so they weren't too difficult to calculate. So both of those figures are going to go in. The 144 and the 24 are figures that we're going to put into our balance sheet. The next figure we've got is the stock at the balance sheet date, which we call the closing stock, of course, and we were given that information in the notes, note 1, and that was 50,000. Okay. The next asset that we see at the balance sheet date is the debtors. Now again, we said it's not too difficult to work out how much the customers owe. It's just the difference between what we sold them and what they've paid us. But I suppose it's a calculation that we need to do. And we're asked to do that and show that calculation. So we'll show it in the form of a T account in a moment. The next one is the bank. How much money was in the bank? If there was any money in the bank. Okay, and again, we don't know. We don't know at this point in time how much money was in the bank. We're going to have to add up all the cash that came in from various sources, all the cash that went out, and what's left in the bank. In this case, there's no opening balance in the bank, but we just don't know what the closing balance is. So it's very hard to figure out what the total of the assets are without doing the calculations. And we do the calculations, of course, in the nominal ledger. The next figures that are going to go in the balance sheet will be, I suppose, the liabilities. And the first liability is creditors. Again, not a difficult calculation. What did we buy? What stock did we buy? What did it cost? How much have we paid so far? And how much is still owing? So it's an easy enough calculation. I'll just do it down here. So, well, we don't know. I'm not going to do it here. Okay. So it's another calculation that we're going to have to do, and we'll do it in a T account. Okay. The next one is the corporation tax. I'll just call it CT for corporation tax. Now this time there's no calculations involved. It's 15,000, so no problem. Okay, that figure will go in the balance sheet as money owed to the revenue. And the next one then, the next is the loan. Okay, and again, it wouldn't be too difficult to work out on the loan, but how we do it is in a T account. So we have a calculation to do, and we'll do that in the nominal ledger, the T account in the nominal ledger for loan. So what it'll involve, of course, is the amount borrowed, the interest charged, and the repayments made. And we'll work that out. So again, not really possible at this stage to work out what the liabilities are. The capital, now remember what capital means. Capital means money owed to the shareholders, to the owners of the business, at least technically. And for a company, normally there's two aspects to this, okay? The first aspect is, well, what did the shareholders invest in the business? And they're, I suppose, technically owed that back. We refer to that as share capital. And we were told what the share capital was. We were told it was 50,000 shares of €1 each, a par value of €1. And so that's a total amount of 50k. There was we didn't issue them at a premium or anything like that, so there's no additional money. If we issued them at a premium, we'd have another account, as you know, a share premium account. But we owe that back. Now, of course, the shareholders are never going to get it back, probably, from the company. Very unlikely. If they want to get their money back, they'll have to sell the shares. Usually that's what happens. Okay. And also what's owed to the shareholders is the retained profit, or the revenue reserves. Now, in this case, we do know what the revenue reserves are because we've just calculated them. We've just calculated them in our profit and loss account, and it's 58,000. So technically, who owns the profits of a business, the retained profits or whatever? Well, the shareholders do. So both of these amounts of money are owed to the shareholders by the company. So the total amount, at least on the capital side, we can figure it out. We can know how much is actually owed. Okay, so these are all the figures that are going to go in the balance sheet. So some we've got to do. We've got to do these calculations. Some we were able to do in our head, or just given to us. But there's 4 there that we need to do. And that's why in the question we were asked to do the ledger accounts for these 4, where that wasn't really necessary for the rest of the other figures in the balance sheet or the figures in the profit and loss account, in this example anyway. Okay, so let's do the nominal ledger itself then. Okay, let's change colour. So the nominal ledger. Well, yeah, okay, so I'll just put in here the nominal ledger. Now it's not the whole thing, so we'll just say it's an extract from the nominal ledger. It's a bit of it. Okay, we're only asked to do 4. So let's do these 4. So how am I going to? What would be the best way? Okay, so we do the bank account first. Okay, so let's do the bank account. So we're going to do a T account for the bank account. Oops. Okay, and we'll give it a name. Okay, so we call it bank account. Okay, and we put the numbers in. We do this blue here. Okay, so the first thing we're going to do is, okay, what money, well, what is, let's look at this bank account. Well, we've got the left hand side is the debit side, okay, DR for debit, and the right hand side we call the credit side. Now, going back to our rule that we talked about, that the bank, of course, is an asset, so I'll just put here asset. It's money in the bank. So we said that anything that will increase an asset goes in on the debit side. Okay, so any lodgements into this bank account will go in on the debit side, and any withdrawals or payments out of the bank will go in on the credit side. That's in compliance with the rule. Okay, the rule that we're doing. Okay, so what we can, I suppose, say then is that any money coming into the bank, okay, we'll put in on that side. Okay, money in, and any money out we're going to put in on that side. Okay, so that's basically that. So what money is coming in? Okay, what money is coming in? Well, maybe we just draw a little diagram here. Here's our company. Okay, here's our company. So what money came in? Okay, well, there's certain money came in from the shareholders. So I'll just put there shareholders. So I think that was 50k. So 50k is going to be lodged into the bank. There's, I suppose, money was put in by the lender, whoever that might have been. Okay, so money came in from the lender, and I think the lender put in 150k, and the customers also put in some money because they were paying for the goods that they bought on credit. And so how much did the customers put into the business, or lodge into the business, or give to the business? And that was 420k. So there we have our lodgements. So I think we can just put those now in on the inside, or the debit side of the bank account. So let's do that. So I'm going to put in here share capital. And we just put in 50,000. The debtors, the customers, remember, are debtors. Okay, so we do that. So put in the debtors. And the debtors, we said, were 420. And the lenders then, in respect of the loan, is 150,000. So there's our lodgements on the debit side of the bank account. Okay, on the credit side then are all the payments that have been made. So what are the payments? Well, equipment first, I'll just put EQ, 180,000. The motor vehicle, just put MV, 30,000. So remember we said at the beginning that these were paid, these amounts were paid. Rent and rates, just to fit it in, I'll just put R and R, and it's 60,000. Oops. Okay, rent and rates, there was wages paid. So lots of payments going out here, lots of withdrawals from the bank account, 180,000. The next one is creditors. These are payments in respect of our purchases, 110,000. We've got dividends paid to the shareholders, and they were 60. Then we've got motor expenses, and these were 18,000. Then directors' remuneration, so lots on the credit side. I'll just put, okay, like that, 25,000. And the very last thing then are the loan repayments. And the loan repayments were 30,000. Okay, so that's that. So let's just bring this down a little bit here. Okay. So what we do is, as you know, to find out how much is left in the bank account at the end of the year, we add up the left hand side and we add up the right hand side, and whatever is the difference between the two is the balance. So let's add up here this figure here, these three figures together. So if we add up those three figures, we get 620,000. And if we add up all these figures, we should get 693. So what's that telling us? It's telling us that 620 was lodged into the bank and 693 more was taken out. So we're left with a situation where we have an overdraft. Okay, so the bank is no longer an asset, the bank is turned into a liability. So how do we show that? Well, we add up both sides, and whichever is the highest figure, which is the credit side here, we put in there 693. Put two lines underneath it. And this side here only adds up to 620, but we make it 693, the highest, the total of the highest side. Now the right hand side, or the credit side, is fine, but this side here is clearly not fine, and the missing figure is what we call the balance. So we're going to put in there the balance, and it's the balance on what date? The end of the year. Okay, and the balance, the difference between those two, is 73,000. Okay, bring this down a little bit further. Now this account goes on and on year after year. So at the beginning of next year, we're going to have a balance in this bank account. Okay, so the balance will be on the 1st of February 2020. And we're going to start off next year with an overdraft of 73,000. So balance there indicates that there's either an asset or a liability involved, and if it's on the credit side here, it means it's a liability. So when we're putting it in our balance sheet, it'll be under current liabilities. Okay, the next T account then is debtors. So let's do that. Okay, so the debtors T account. So we just do it like that. Okay, so the debtors. So again, it's an asset type of account. So it has to follow the rule. If we're going to increase the debtors, any transaction that increases the debtors, we debit this account, and any transaction that reduces the debtors, we credit this account. So remember, what's the debit side? Debit just means left, and credit just means right. So what will increase the debtors? Okay, well, when we sell goods on credit. And what were the sales? So we've got sales here, and the sales are 580,000. Okay, and on the other side then we've money received. So where did that money go? We know that it went into the bank. It was on the lodgement side of the bank, 420,000. Okay, and that's it. There's no, in this particular case, there's no other transactions in there in the debtors account. So we add up both sides. The left hand side comes to 580, the right hand side 420. So we make both sides equal to 580. And obviously the right hand side doesn't add up to that, so we've got to put in here the missing figure, or the balancing figure. The balance on the 31st of the 1st 2020 is 160,000. And we bring down the balance then, so there's going to be a balance on the 1st of the 2nd 2020 of 160,000. Just bring that down there like that. Okay, the next one then is creditors. So we're asked for these 4 T accounts. Okay, so creditors is a liability type account. It's money we owe our suppliers. So that's what that is. So, but again, we have a debit side left and a credit side right. So what will increase a liability? What do we do when we increase a liability? We credit it. So what will increase our creditors? Well, whenever we buy stock on credit. So we're going to put our purchases in here. So our purchases are 160,000. and we paid for some of these. So this will reduce the money owed to the creditors, 110,000. We add up both sides, and clearly then this side is the high figure, 160. So we make that the total of both sides. And the balance on the 31st of the 1st 2020 is of course 50,000. Okay, so there's only one T account left. So where we put that? I hope, yeah, okay. So let's put the loan account in here. Now, the loan account is a liability. Again, debit side, credit side. So again, we follow our rule. So what increases the loan? If we do anything that increases the loan, we put it in on the credit side because it's a liability. So what was that? Well, we borrowed the money, and remember we put the proceeds of that loan into the bank. So we put in their bank 150,000. Okay. And then what else increases the loan balance? Well, the interest charged by the lender. Okay, by the lender, and the interest charged was 12,000, I think. And what will reduce the loan? Well, any repayments, and the repayments also came out of the bank, you might remember, and they were 30,000. So again, we add up both sides. So on the right hand side it's 162. The left hand side is 30. We make it 162. And there's a missing figure, which of course, as we know now at this stage, the balance at the 31st of the 1st 2020, and the balance is 132. So remember, it's the balances that end up in the balance sheet. We bring down the balance on the other side, we always do that. So the balance on the 1st to the 2nd 2020 to start out next year will be 132, and that'll be the opening balance next year. Okay, well now we're ready to do our balance sheet. Okay, let's do the balance sheet. So we go over here and we bring it down. Okay, so what color will we use for this? Let's try the let's go back to this one. Well, no, let's, yeah, okay. So again, when we're doing the balance sheet, we put in the name. So it's what did we say it was? Computel. Okay, and it's Computel Limited. And we put the name of the document, which is the balance sheet. Okay, and it's as at the 31st of January 2020. So we now have all the figures we need for the balance sheet. Remember, we were earlier on there, we were saying that we were doing this equation and we were we were short of some figures. Okay, and the figures that we were short of was debtors and bank and creditors and loan. And now we have those figures. We've worked those figures out now in this nominal ledger extract. Okay, so now we should be able to fill in these figures and the equation will balance. Okay, so I won't bother doing that, but we could do that. We could put in the debtors and the bank figure, the creditors and the loan figure, and this equation would balance then at that stage. But we won't do that. We'll go straight on to our balance sheet. I think we're reasonably confident that we have the figures that are necessary. Okay, so let's do that. So we're going to do balance sheet then as at the 31st of January. Okay, so the first thing we're going to do is, of course, the assets, and the first asset is the fixed assets. Fixed assets. Okay, and we're going to look at the cost of those fixed assets, and the aggregate or accumulated depreciation, or depreciation to date, if you like, and when we subtract those two figures we get the net book value. Okay, and everything's going to be in money, so we put in a euro symbol. Okay, so what are the fixed assets that we have? Well, we have equipment. And the equipment was, of course, 180,000. And the accumulated depreciation is easy because it's only 1 year's depreciation. And we worked that out already to be 36,000. And I think we worked out in our equation already that the net book value is going to be 144. So no difficulty here. Motor vehicles. Okay, the motor vehicles. Okay, before I go on, I'll just go back to the bank account and say, this bank account, we said we were going to advise the company on liquidity, okay? And when we're talking about liquidity, we're talking about cash in and cash out. So I suppose the liquidity situation is under pressure, I suppose. We have a problem, we have a deficit situation in the bank account, okay? So there's more money going out than coming in. So the business does have a liquidity problem. And how to fix a liquidity problem, okay, if we're talking about a liquidity problem, there's a number of ways, I suppose, that we could fix the liquidity problem, or could have fixed the liquidity problem, or what caused the liquidity problem. Now, one big issue that has caused the liquidity problem is that this business purchased the equipment and the motor vehicles for cash, took the money out of the bank, didn't get a particular loan maybe for that. Maybe they should have borrowed money particularly for this equipment and the loan. Maybe they could have leased this equipment. And if they had leased the equipment and the motor vehicles, well, then they wouldn't have had to spend as much money. They would have had just a 1 year's leasing charges. And that would have freed up that money to be still in the bank account. Another thing that they could have done to solve the liquidity problem is maybe that the shareholders could have put more money into the business, or they could have borrowed more money. And that would have brought extra money into the business. That would have solved their liquidity problem. Another factor that might improve the liquidity situation is if they didn't give as much credit to the customers. Maybe they should divide their customers between cash customers and credit customers, and for some customers they might insist on immediate payment, and that would speed up the cash coming in, and that would improve the liquidity. They might try to stretch, they might delay paying some of these expenses or some of these payments to creditors. That might, but looks like they're just complying with the credit terms of 1 month, and when not too sure about that. So you could see maybe they could delay paying on the creditors a little or whatever. Okay, so that's that. Just thought out that's when we're talking about the liquidity. But we're back to solvency now, I suppose, with the balance sheet. So let's carry on with this. Okay, so we've got the cost of the motor vehicles, we said, were 30,000. And the accumulated depreciation, aggregate depreciation, was 6,000. Okay. The next thing, so that's the net book value then, is just 30 minus 6, or 24. Okay, so we'll add up each of these columns. Okay, and here we get 210 is the total cost of all the fixed assets. We don't really need that anymore, so 2 lines underneath it. And here we've got 42,000, isn't it? 42,000. Don't really need that anymore. And the figure we're interested in is this one, 168. So we won't put any lines underneath that. Something's going to be added on to that or subtracted from it or whatever at a later stage. Okay, current liabilities are next. Current assets are next. These are assets that are either cash or something that's going to be turned into cash shortly. Okay, so what's going to be turned into cash shortly? What assets are going to be turned into cash shortly? Well, the first one is the stock, because we're going to sell it and presumably get paid for this stock. So that will turn into cash shortly, within a year anyway. And for no particular reason, we're going to put it in under aggregate depreciation. It's nothing to do with aggregate depreciation, but we put it in there. The next asset that's going to turn into cash is the debtors. Okay, and how will that turn into cash? Well, the customers are going to pay us. Okay, so these debts will turn into cash. Now normally we'd have the bank figure, but of course there's no money in the bank, but let's just put it in anyway, so to indicate that very often there will be a bank figure, but in this particular example it's overdrawn, so there's no money in the bank account, so we just leave it at that. Okay, the next section is well, we're going to, I think it's a draft balance sheet, so I think we can just call it current liabilities rather than the full title. If we were publishing these accounts, it's normally called creditors amounts due within 1 year, but we just call it current liabilities in this case, so it's creditors. So we owe this money to our suppliers and it has to be paid soon, and we owe the creditors, we worked it out in the T account, we owe them at the end of the year 50,000. Who else do we owe money to? Well, the tax authorities, so corporation tax, the revenue commissioners, corporation tax. This time we actually put in the full title corporation tax, because there could be other taxes like payroll taxes, PAYE, PRSI, USC, or it could be VAT owing and that. But in this case, so we have to identify what type of tax it is. So the corporation tax owing is 15,000, and then the next current liability we have is the bank overdraft. So I suppose when you have a bank overdraft, you owe the bank money, and we know what that is because we worked it out in the T account, 73,000. So the total of the current liabilities is 138,000. We'll put a line underneath it. So what do we do next? Okay, the next thing we do is we're going to subtract our current assets and our current liabilities from each other. Now remember, in our equation earlier we saw that we're subtracting liabilities from assets, so we're going to do the current from the current first. Okay, and the answer we get, we do the difference in the value of these two figures we call net current assets. Net current assets, and we put a line underneath it. Now this is we calculate this figure of net current assets because it tells us something useful about the business. Okay, let's calculate it first. So 210 minus 210 minus 138. Let's see, make sure we line it up properly. We go up here a little bit. So we're going to just put it in here like this, and it's going to be 72,000. Okay, so what does that 72,000 tell us? So it's the excess of current assets over current liabilities. And what this figure tells us is, it tells us the ability of the company, or lets us know the ability of the company to pay its debts, its short-term debts as they fall due. So is this business able to pay its short-term debts as they fall due? Well, what are the short-term debts? Well, here they are here. The creditors, the corporation tax, they have to be paid soon. And I know bank overdraft is always short-term. Okay, you have to bring your account back into order, once a year at least with a bank overdraft. So all of these amounts, these three amounts, totaling 138,000, have to be paid within the year or soon. Okay. And how is the business going to pay that money? Well, it has actually no cash. However, it has got assets that it's going to turn into cash. So we say that there's an excess of current assets over current liabilities, which we call net current assets. So the business appears that it will be able to pay these debts as they fall due. Okay, that's able to. There's an amount there to pay these debts. So in the short term, we should be able to pay the debts. Although in the very short term, maybe the overdraft is going to get greater, in the very short time. Okay, so that's our net current assets. Okay, so we seem to be solvent in the short term. So what are we going to do with that 72,000? Well, we're going to add it to the net book value of the asset, of the fixed assets up above, and we get 168,000. Sorry, we're not going to get 168,000. We're going to get something else. Okay. So what will that add up to? So we're going to add up what's above here. So we're going to add 168, and we're going to add 72 to it. So that should give us 240,000. And we give that a name. We give that 240,000. Well, we don't actually give it a name, but you can see what it is. It's all the assets, current and fixed, less the current liabilities, and it's 240,000. Okay, so the next thing I've got to put in is there any other liabilities? And of course there are other liabilities. These are long-term liabilities. So again, I'll just put them in as long-term liabilities. That will do, because this is a draft balance sheet. Normally, if it was a publishable balance sheet, we'd call it creditors, amounts due after more than 1 year. But long-term liabilities is fine. So loan, the balance on the loan, we calculated that, remember, in our T account for loan, and we said that the balance, the closing balance, was 132,000. So we put that in there. And again, it's a liability, of course, so we're going to subtract from the 240 above. And what we get is 108,000. Okay, so it's 108,000. So I suppose what we can say about the solvency of the business, okay, we can say that the assets minus the liabilities are 108,000. So I think we can say that the assets are greater than the liabilities by 108. So our kind of test for solvency is okay. So it appears that this business is solvent in the long term as well. Okay, so what we call that 108? Well, we call it total net assets. Okay, total net assets. So the total net assets are 108. Right, and not to be confused with the net current assets of 72. So we've got to kind of be familiar with the meaning of these two. So net current assets are just current assets minus current liabilities, and total net assets are total assets minus total liabilities. Okay. Now, if the current liabilities were greater than the current assets, this figure would be negative, of course, as we said. The current liabilities greater than the current assets, we'd call this net current liabilities. And if the total liabilities are greater than the total assets, we'd call this total net liabilities. Okay, so that's the left-hand side of the equation done. Okay, the left-hand side of the equation. Now we go on to the right-hand side of the equation, which we've already calculated the figures, but let's put them in as they should be put in. So we've got this section, capital and reserves. So we don't just call it capital, because we know that the capital in a limited company is divided reserves. So it's divided between what the owners have invested in the business, which is owed back, and the profits of the business, which belong to the owners and are technically owed back as well. So capital and reserves. So let's do the capital first. So the capital is the ordinary share capital. Remember, there are other types of share capital, but preference share capital, but it's rare enough. Preference share capital is not that common. All companies have ordinary share capital. I put in ordinary shares, so let's get that out. Ordinary share capital. So this would be the par value of the shares that have been issued. And we know the par value is 50,000. And if the shares were issued for more than the par value, well, we'd have a share premium account here. Okay. And the other aspect of capital and reserves, the reserve section, we just call them the revenue reserves, which of course are just the retained profits, which is the final figure in our profit and loss account, was 58,000. And so we did this calculation already, so it's 108,000. It's the right hand side of our balance sheet. Okay, so that's that. So basically what we've done, three things. I think we've done the profit and loss account, we've done some T accounts in our nominal ledger, and we've done the balance sheet. Okay, so this is again a common question, and in your continuous assessment we did something similar to this in respect of a sole trader, and now this is the version, if you like, for a limited company. Okay, so talk to you soon. All the best.